Hello and welcome to this session on IFRS 17 insurance contracts. This will be a very simple introduction to IFRS 17. By the end of the video, you'll be able to appreciate the structure, objective, and how to use IFRS 17 when it comes to accounting insurance contracts. IFRS 17, similar to other standards that speaks about assets or liabilities, follow a very similar framework. It starts with when to recognize a particular asset or liability, what should be the initial measurement value for the asset or liability, how will the changes to this initial measurement be treated in each subsequent reporting period. Eventually, if there are any modifications, what will happen to the contract and when to de-recognize a particular asset or liability, in this case, an insurance contract. The standard goes with the default approach or a default way of treating insurance contract, and then it also permits entities to follow a more simplified approach called premium allocation approach when certain conditions are met. I will leave a link below the video with the PDF file used in this presentation. You can use it as a quick reference guide if you need it. The objective of IFRS 17 is straightforward. It is to help the users assess the effect of insurance contract in profit and loss, in balance sheet, and in cash flow statements. If an insurance contract has got other components, say for example an embedded derivative or some other components, IFRS 17 requires the users to separate each one of them and treat it appropriately. Also in IFRS 17, an entity shall always identify portfolio of insurance contract. This is where a group of insurance contract with similar risks and that are managed together will be treated as one group of contracts under IFRS 17. IFRS 17 also prevents an entity from netting off onerous contracts from rest of the portfolio, i.e. when a contract or a group of contracts are expected to make loss, then an entity is not permitted to group them with other profit-making contracts. An entity shall recognize an insurance contract at the earliest of these. An entity shall recognize a group of contracts at the earliest of the following: at the beginning of the coverage period, the date on which the first payment is due, or when a group of contract becomes onerous. We already saw what onerous contracts are. These are contracts that are expected to make loss, or in other words, expected to have a net cash outflow. We have now come to the core of IFRS 17. After an entity meets the criteria for recognition, the next step is initial measurement. What should be the value at which an insurance contract should be measured, either as an asset or a liability on initial recognition? The formula for initial recognition is very simple. It is sum of fulfillment cash flows plus contractual service margin. We'll take a moment to understand both these terms. These terms are very essential to understand IFRS 17. Let's begin with fulfillment cash flows. Fulfillment cash flows are the net cash flows expected from a group of insurance contract adjusted for time value of money, adjusted for financial risk and non-financial risk. Let's look at a very simple example. If we have a contract that's over a period of 10 years, expected inflows will most likely be insurance premium. That will be the largest component of gross inflows. There will be outflows because of claims. There will be outflows expected from servicing or the cost of servicing the insurance contracts. And because this is over a period of time, there will be a reduction for time value of money. And then there are adjustments for two other type of risks: financial risks and non-financial risks. Financial risks could simply be credit risks, for example. Non-financial risks are a measurement or an estimate of uncertainty around amount and timing of future cash flows. The net cash flow after all these adjustments are fulfillment cash flow. Let's move on to contractual service margin. Contractual service margin represents the unearned profit. In other words, this is the expected future profit from the group of insurance contract. An entity is allowed to recognize contractual service margin only when the group of contracts are profitable. So when there are onerous contracts, an entity cannot recognize contractual service margin. And contractual service margin on initial recognition is simply a negative value of fulfillment cash flows. It may come as a surprise that initial measurement of profitable insurance contracts are zero, because fulfillment cash flow shows the expected net cash inflow, and contractual service margin is exactly the opposite of that. Both of them offset each other and initial measurement is zero. This is because both fulfillment cash flow and contractual service margin represents what an entity could earn in the future. Because this is at future date, this is 0 on initial measurement. So here, if we take a moment to understand two core principles that's driven by IFRS 17, they are: if an entity is expected to make profits, don't recognize anything in profit and loss or even in other comprehensive income. If an entity is expected to make losses in the future, recognize all of that in profit and loss immediately. Before we step on to subsequent measurement, let's do a quick recap. Initial measurement is simply sum of fulfillment cash flow and contractual service margin. Fulfillment cash flow is simply the net expected future cash flows after adjusting for time value of money, financial risk, non-financial risk. Contractual service margin is simply the negative of fulfillment cash flows if a contract is expected to be profitable. So if a contract is expected to be profitable on day one, the value will simply be 0. If a contract is expected to make loss, i.e. if a contract is an onerous contract, then the entire loss should be recognized in profit and loss statement on day one. Now let's move on to subsequent measurement. Now that you know what happens when a contract is initially measured, subsequent measurement becomes much simpler to understand. If a contract, let's say, has got a 10-year period and 1 year has passed as on date of subsequent measurement, we'll know for certainty what happened during this period. So we can just capture that in our balance sheet and profit and loss statement. And there will be some estimated future cash flows for this period. And the treatment will be very similar to initial recognition for the second component. An entity would have also provided insurance services during this period, so there will be some profit or loss for this period that should be recognized in the profit and loss account. This is the framework for subsequent measurement. Now let's dive right in. Subsequent measurement is simply sum of two components: liability for remaining coverage period and then liability for claims incurred. Liability for remaining coverage period is very similar to initial measurement. It is simply sum of fulfillment cash flow and contractual service margin. The standard does explain how contractual service margin should be calculated for subsequent measurement. We'll go through that. But the logic is still the same. Fulfillment cash flow is expected cash flow from the future period, and contractual service margin is opposite of fulfillment cash flow plus few other adjustments. Liability for incurred claims, that is for the past period, is simply fulfillment cash flows related to the past service. Now let's look at how CSM should be measured during subsequent measurement periods. An entity has to first identify contracts which have direct participation feature and which doesn't. When a contract has got underlying investments, something like a unit-linked insurance plan, then it is a contract with direct participation feature. The difference between them are highlighted in red for your easy reference. The first and foremost principle does not change. It's given in point 3 here. The negative value of fulfillment cash flow will still be included in CSM. One thing we must continue to remember is the contract should still be profitable and not onerous. 4 other components that should be adjusted in CSM value are: any changes for new contracts that should be added into the group of insurance contract, unwind of interest income. At the start or at the initial recognition, we discounted future cash flows for time value of money. Now it's time to unwind and recognize them into the CSM. Then adjust for any foreign currency differences, foreign exchange differences, and finally amortize CSM into the P&L. This is the insurance revenue for the period. When it comes to contracts with direct participation feature, the treatment is very similar, except instead of interest unwind, here changes in fair value of the underlying items are captured into the CSM. We looked at several components that could affect the carrying value of an insurance contract. The changes in carrying amount because of the following goes to P&L: insurance revenue, service expenses, effect of time value of money, or effect of financial risk. Now let's look at an alternate approach permitted under IFRS 17, a much more simplified approach provided certain conditions are met. 1. The liability under this approach does not materially differ from the default approach in IFRS 17, or if the contractual tenure of the contract is less than 1 year. At the time of initial measurement, the liability on premium allocation approach is simply the sum of premiums received if any, and insurance acquisition cash outflows. Under premium allocation approach, subsequent measurement has got the following adjustments. Liability starts with the carrying amount of previous reporting period, and then any premiums received are added to it. There are adjustments are made for financing components, that is time value of money and financial risk. And then insurance revenue for the period is reduced and any claims paid during the period are reduced from the liability value. Now the question is, what happens when there are modifications to insurance contract? When does some change to the contract qualifies as modification to the insurance contract? IFRS 17 states out few conditions when changes to the contract are to be treated as modifications to the insurance contracts. It also says when a contract switches from with direct participation to without direct participation or vice versa, it is treated as modification to the contract. Also, if a contract that is following a premium allocation approach does not qualify for the same approach after modifications, then that type of change is also treated as modification to the insurance contract. What happens when there are modifications? IFRS 17 requires the original contract to be de-recognized and the new modified contract to be recognized as a new contract as per IFRS 17. When should a contract be de-recognized? A contract should be de-recognized when it is extinguished, that is, the obligations under the contract have expired or have been discharged, or when there are modifications as per IFRS 17. That is the conditions we looked at in the previous slide. Thank you for watching this video on IFRS 17. If you are interested, you can also check out my other IFRS summaries. I'll leave the links in the description. Thank you.